everybody. Well, welcome to another episode of Cannabis Unlocked with Key Investment Partners. I'm excited to be here today with Brian Kuo. Brian and I kind of met through some of our thought leadership. We published a white paper a couple months back. I saw that Brian downloaded it, reached out to Brian, got to know him, his background, which I found incredibly interesting coming from Big Four accounting and ultimately into the cannabis industry. Full disclosure, Brian and Key have now successfully gone into partnership together. He's joined us in our most recent transaction, MM Brands. We'll get into a little bit of that on the podcast. But Brian, why don't you give us a quick kind of 30-second background on who you are, and then I'll kind of dive in for some questions here. Great to have you on the show.
Yeah, good to have you, or good to be here. Yeah, I tried to do it in 30 seconds, but I originally started in Big Four accounting, and I was at PwC. Ended up disliking that, went into recruiting for a bit, but this was during 2008, 2009 financial crisis. So I decided I needed to get back into accounting. Hated it again, so I went back to school to ultimately try to become a professor and get a PhD in physiology, which in higher ed, I found out it was the most corrupt industry I had this pleasure of working for. So I jumped back out. And what ended up happening was started working for a firm where they recognized what I was able to do, fixed a lot of problems. And then what happened was that I ended up going to another firm where they interviewed me for a lower level position for advisory. And in that meeting, this is in 2016, Ty, the partner, asked me a question, the fateful question, which is, I want you to lead our team. I want to hire you two levels above the actual role that we saw. But are you okay with cannabis? And I said, yeah, I've always thought cannabis is fine. It's not something I particularly used, but I've always thought it should be legalized, and I'm happy to work with it. And full disclosure was that weekend was the first time I ever tried cannabis because I figured I should at least, know the product because it doesn't make sense to work in something and not understand it fully. And then my career took off because at that time in 2016, accountants were super risk averse. So none of them were entering the cannabis space at the time. There's just a handful of big four accountants inside and working on it. So my career just skyrocketed. And I got really lucky where I was able to work with some of the big names. For example, the early stages of Wyld, Wyld Confections.
hmm
Early on in Power Body Care, I worked with, I was a fractional CFO for True Terpenes for a few years and then ended up working on a startup that I met while I was at True Terpenes, and I just been super blessed and super lucky this entire time.
Yeah. So that's interesting. So you kind of jumped into some of my next questions here, which I certainly appreciate. So I guess what was it that made you take the first cannabis opportunity seriously? Was it because you believed that the plant, should be legalized and you saw the lack of expertise or folks like yourself in the space? And I guess what do you think you misunderstood the most about the industry when you first jumped in at that time?
I would say for me, it was a little different than most people. It was pure fascination.
Okay.
I'm more of like a free markets kind of guy, free drug use kind of guy. I think people should be free to try the things they want to try. And at the time when I realized that cannabis was kind of a blue ocean that no one had really crossed it before, and it's very rare you get the opportunity to be part of this new industry growth. So I decided, I early on I always thought it'd be really fun to work with. But I have seen a lot of people and how much the plant is able to heal them. I've met a lot of people who have had cancer or had cancer and unfortunately even passed away where it was something that helped them so much with pain relief that I just realized it doesn't make sense the way that it's, illegal in the US at the time, And really the biggest misconception I had is I just didn't know the industry that well. It was one that's really relationship based more than anything. So it was one where a lot of other industries, it's impossible for me to just get the cell phone number of a CEO and talk to them that same day. Cannabis, I could just literally message someone on LinkedIn, get their number the same day and talk to them. And people like to hang out a lot. That was one thing I actually thought was hilarious, which was every time I had a new client, they'd invite me just to hang out during the weekends or after work to like, smoke a bowl or something. And it was very interesting. I actually tried my first joint with one of my clients and I got to experience my first bout of paranoia and realize I'm very sensitive to the plant. I'm actually one of the people where if I take a few hits off a joint, I'll hallucinate. So it's pretty
Yep.
interesting. Yeah.
Yeah, you mentioned that before. Interesting that you brought up Wyld. Wyld is a wildly successful company. I'd say arguably the most successful edibles company, definitely in the country, which I assume means the planet as well. Wyld actually just started a partnership with one of our portfolio companies, Botanica. They are going to be working with the sales and marketing team and expanding into wild territories. It's the first time they've done something like this. We're incredibly excited about that. But considering that you worked with them, I'm curious, what did good look like there? What habits do you think really helped Wyld scale to the business that they are today?
Well, pardon, my cat's on the keyboard right now. So, interestingly, like any company that I've worked with in the past, cannabis or non-cannabis, there's just two parts to it. One I find is like the ship itself, meaning the business. Does it make a lot of sense economically? Is it structured well? Is it a sound ship that can cross like a big ocean? So one part is the ship, and the other part is the captain itself. Like who is the captain? Do they have integrity? Are they really hardworking? Are they really intelligent? All those different factors. And what I started realizing through a lot of my clients and a lot of the people I was working with is actually the captain actually matters more than the ship most of the time. And it's just something that is very common as a theme where if you have a fantastic operator but a so-so ship, they can make it work. If you have a fantastic ship but a terrible captain, it will sink. I've just seen this again and again.
Yep.
Wyld is an example where both things are amazing. They truly are. And I was working with them doing some fractional CFO style work and some advisory work. And I was working with one of my colleagues, Ty Carr. When we saw this business, it's just beautiful.
Yep.
The founder, Aaron Morris, fantastic, fantastic operator. I can't say better things about him. He knows how to inspire a team, and he understands the fundamentals of a business, and he understands like all the facets. Enough. He understands the total uh, cohesion of a business to make it run. And then just the business itself was fantastic economically, their marketing, sales, everything. They just did everything quite right, and you could see it early on. If I had been able to invest in it earlier on, I would have thrown money on it.
Absolutely. Yeah, no, we're super excited to be partnering with those guys. All I can say is the feedback that we've gotten from our portfolio company, Botanica, and structuring a deal with them is that it's been very friendly. Everything has been very transparent along the way. And none of that's shocking to us considering the success that we've seen those guys have. So really cool that you actually got an opportunity to see those guys in action as well. Can't stress enough that it all starts with great operators. um, Great ship, bad operator, you're still going to sink. So I totally agree with you there. I think switching gears a little bit now too, though, to getting even more intimately involved in the industry. Talk to us a little bit about Vape Jet, the origin of that. Walk us through, maybe meeting Ryan, taking the leap into Vape Jet, and why I'd say kind of like sweat equity plus real operator grind model works so well there.
So I was doing fractional work for True Terpenes, fractional CFO work, and one day I went to work early by just an hour. As I was walking into the building, someone stopped me, one of the sales guys, and said, "Hey, do you want to see a demo?" And I said, "Sure, what's the demo for?" And they said, "It's for an automatic filler." And I responded, "Yeah, definitely would love to see that. We need better fillers on the market." So I walk into this room and immediately I'm blown away because what I see is there's this machine that looks like it's handmade and it's connected to a laptop. And on the laptop, it looks like there's some sort of like machine vision on it. So I looked at it as like, wait a second, like this looks made from the ground up for the product itself, for cartridges, for cannabis, and it looks like it has software and hardware. I mean, thought, who made this thing? And in walks a guy named Ryan Hoyt. And usually I'm really talkative, very verbose. You can't stop me from just going on and on. But I was actually silent this entire meeting because I was trying to understand Ryan as a person. And
Hmm.
Ryan talked about his technology. There were some typical questions asked about like temperature zones, capping solutions, throughput, those types of questions. And at the end, he said a couple magic things. One is that he already had pre-sales. So he had like 5 pre-sales at the time. And number two, he was looking for strategic investment from someone who he felt like not just taking money, but could also like help him with get things off the ground.
Sure.
So immediately I disclosed to the company after he left that I was going to talk to this guy more. And so I emailed Ryan. Little did I know he was actually military intelligence. So once I emailed him, he was like checking me up and trying to find out information. But he agreed to meet me that weekend. We ended up chatting for 4.5 hours straight. And at the end of it, I wrote a check to him, agreed to give him sweat equity in like helping run and get the business run going. And we ended up being partners. And that was back in, I think, like March of 2019.
I
And
don't
then
think I
just
realized that, Brian. So you were really there at the launch. You helped launch the
yes.
business from the start.
Yeah,
So
yeah.
Ryan created this technology. you got in the weeds and you figured out, okay, there's something here, not only with this technology, but with this person. Those pre-sales probably gave you a lot of confidence to write that check as well.
Yes, yeah, and then just I mean the because I have experience doing the CFO position, in my mind I was doing the economics of the machine itself. And at the time he was trying to do the low cost solution. But even with the low cost solution, the BOM cost, the build of materials was so low that it just made so much sense. It's because in that situation, the value truly came from Ryan's ingenuity. The fact that he was able to create the software and hardware means that it didn't have to be outsourced. He didn't have to buy an existing solution, so it immediately brought the cost of the product down exponentially because he was the cost essentially. So his
Or
sweat equity made it so it was pretty valuable. As we went through different iterations of the company, we realized because the thing that was so amazing about Ryan and building this company is he was somewhat like a Elon Musk style person where he was able to rapidly iterate the product to fit the needs. So a good example is we were building this product and one of the operators who bought a Vape Jet gave us feedback that the reservoir shouldn't be straight up and down. It should be tilted because if it's tilted, then you can get more of the material at the corner of the reservoir.
interesting.
That same day, Ryan designed and 3D printed brackets to make it so it could turn and then shipped it out to everybody so they had a better product. And because other
That's amazing.
companies, yeah, other companies had built a product that was modified from other existing solutions, they weren't able to do those rapid iterations at the time. I think probably some people can do it now, but at the time, no one was able to rapidly iterate like us. But we kept rapidly iterating and became one of the more expensive solutions because things started costing more and more as we improved the product to be able to service everybody.
Yep, yep. Well, it resonates, I think, a little bit with the conversation that we had right before this call around, not skipping out on the baby items. Get the expensive item because it's going to save you time in the long run. So,
Oh yeah. Well, that's the thing is that in not to get too in the weeds for the product itself, but the difference at the time, especially and still now, is we realized quickly one of the biggest problems was the customer support side of things because it's not just you're buying this machine and forgetting about it. Machines break. The product is difficult. Cannabis extracts are one of the most difficult products to work with because of the viscosity and the solution itself. It's so hard to work with. So inevitably bad things will happen. Well, we were thinking, well, how can we actually quickly help people? That's when Ryan started creating separate camera systems where we can log into any machine in the world that's being used right now and see exactly what's going on. It leads to like a lot of hilarious stories about when people said there were issues and we realized it was not the machine, it was something else going on. But yeah, at any given time, we can see all the data that's being used for any of the machines that's out in the field, and we can help service any of those machines. Quick phone call, talk to someone, they can log in the machine, see what's going on, and help troubleshoot.
yeah, that's awesome and incredible insight that you guys have too. So, part of what we try to do on the podcast, outside of learning somebody's story and putting it out there, is giving our listeners kind of actionable feedback that they can use when they're looking at opportunities and doing diligence. So, kind of switching gears a little bit, you're a CFO. So, kind of what's the CFO toolkit in cannabis? So, when you step into a company or you're diligencing one, what are the first five things that you want to see to know that the business is real and investable? Revenue, quality, margins, inventory, controls, compliance, etc.
Well, it's kind of funny because there's a few different ways to do this, and there's no one way to get the answer because in the end it's similar to any speculative thing, which is you're trying to guess the future of how a business is going to invest at the time, make sure the value get is either equal or less. If you're doing like a Warren Buffett style, you're trying to get a little bit get it for value investing, get it for less than it's actually costing. But usually, like the first thing I just want to know is that they actually have financial statements. Like they're actually
Yep.
there. Like that's the whole thing is that what you realize quickly in cannabis is that there's some nightmare solutions out there. And because in 2016 through 2019-ish, there was a lot of bad behavior. And the bad behavior was just based off of true excitement, almost like crypto, very similar situation.
Sure.
Where everyone's just pouring capital into it with almost no due diligence. And it became the norm to not have financials and still get funding. I mean, I saw it everywhere.
Crazy.
Yeah, it was crazy times. And you'd see things that made no sense too, like, 100x valuations of based on revenue. And it's like, what, how does that work? I mean, it's going to take you a millennia to make that back.
Yep.
So I think number one is just want to make sure there's actual financials there. Number two,
Spoken like a true accountant. I like it.
yeah, like there's actually financials there, but that's when I start trying to step away from just the accountant mindset because if you only look at things as like an accountant, you'll almost never invest in something. There's just too many factors. You'll get paralysis by analysis. It's
Sure.
not exact. So really what you want to see is, do you think the operator is someone who can take it to the next level? That's about it. Are they good? Are they good? And like number one, are they honest? Number two, are they hardworking? Number three, are they intelligent? It's really nice if number four you get along with them, you think they're funny.
Yeah.
If it can make you laugh, that's always a really good thing. But those things are really important. So I think the main factors are similar to what I was saying as an overall philosophy. Is the ship good? Is it sound? Does it make sense? Can it cross the ocean? Number two, does that captain make a lot of sense? So really, like it's more of just like three things for me rather than five. It's the number one thing. The only reason I say do they have financials is because usually it means that they're wise enough to keep the operations at least in the right shape. And that really matters for the sound ship. I find that if there's companies where they're just letting the financials go awry, it typically means that they don't understand the full operations of their business. It means that their ship is not sound. And even if they're making money, if that's the case. I've worked with a company before where I won't name them, but I was told that the financials were about 80% in order. And I had a lot of trouble getting them. So finally I was like, I'm just gonna work with you and go see, take a peek and engage with them, took a peek. It was less than 2% done. And it's no
Yeah.
joke. Like it was literally the worst financials I'd ever seen.
And scary to think that they actually thought they were 80% of the way there too.
Exactly. Yeah. And so like it was and that was one where I worked really hard on like, righting the ship in terms of financially. But that business was actually doing really well when it comes down to like cash flow and it was very, very profitable. But that was a sign for the future because I don't know about now because I don't work with them, but my guess is it's not even close to what the business used to be. And that was like a
Yeah.
telltale sign. So those financials do matter. That's the accounting side of it. And the number two and three side, is a ship correct? And that can mean a lot of different factors. It can mean a lot of different, like, and a lot of them are qualitative versus quantitative. And then
Yeah.
the same with the actual person themselves. It's always a guessing game, though. It's a lot like dating in the end. Sometimes you don't know because you're just, that when you're dating someone, they're trying to look as good as possible. They might give you answers that are the idealistic ones that will make it so that you actually stay with them. But truthfully, once you actually get, like, you're dating, then you start understanding a lot more of the business. So sometimes you just have to pull the trigger, and that's why you have diversification and multiple investments. That makes it so
Yeah.
that likely, hopefully, one of them you were right about.
Yeah, yeah. No, I think everything you say resonates tremendously. And anybody who's conducted diligence on a company, whether public or private, look, you have to do the fundamental bottom-up analysis to really understand a business, figure out if they've got the ship in order, like you said. But I think for us, what resonates the most is really understanding the operators that you're investing behind. Like integrity is so important. You said something that I thought was a little funny because, number four, can they make you laugh? Our due diligence process, and you've been a part of it, Brian, is, it's very thorough from a fundamental perspective, but the nature of the long, thorough process means that we get to know the operators quite well. And at
Yeah,
the end of the day, like, look, whether they make me laugh or not, that's a bonus. I take it more of the sense of we really have like a no asshole policy.
yeah, yeah,
If you're tough to work with just through diligence, it's going to be so much tougher to work with you once you take our money and we're invested in your company. So I actually think that number four, like, do they make me laugh or do we get along? Do personalities collide? Is actually really, really crucial in getting the right team together. We've been on both sides of that. We've
yeah,
learned the hard way in working with really tough folks, and we've also learned, I guess, the opposite of the hard way, the easy way that, in tough times, you'd rather be standing next to a guy that you can get along with, that has integrity, that's not going to try to pull the wool over your eyes, that's going to answer your calls, that's going to take your advice, and that you can work together on solving problems. Because I think the one thing for us is nothing ever goes to underwriting. Plans always have to change, and that ability to pivot in the face of adversity or whatever it is very important. And making sure that you've got operators that are aligned is incredibly important. Maybe the most important thing outside of the basics, which is, you got to have your fundamentals in order. So,
yeah. I think it's what happens with dating too, though. Like, because what's
yeah,
that is happening a lot of times is like this person make me laugh. Like,
yeah,
if they're making you laugh, you usually like already win. Like
yeah.
that's how it's like it's gonna work out.
Yeah, yeah. I mean, you can ask my fiance firsthand. I get myself all out of trouble all the time by making her laugh. So sometimes that's the way to go.
That's awesome.
Um,
Yeah.
So moving on, and we're kind of talking about these a little bit, but let's get a little bit more into like diligence-wise items. So like red flags that just kill companies. In your view, what do you think are the most common silent killers? Maybe especially around cash conversion, debt burdens, bad unit economics. What ultimately kills these companies and maybe specifically cannabis businesses?
So because probably a lot of people who are listening to these podcasts already have an idea of like some due diligence. They have, I would say that they're typically not people who are totally oblivious to some of those things. I'll give a couple answers a little bit not less traditional because debt certainly, debt load is bad. It's obviously really bad terms is really bad as well. And if you can look at the actual debt agreements and see what they say, you'll notice sometimes it is just a deal killer really because they'll say stuff like you can't invest in another company. Well, well,
Yeah.
why are we even talking? If like, because I've had that happen before where there's a company that was looking to acquire another company, but if you actually read deeply into their debt agreements, they weren't allowed to unless they talked to the debtor, and the
Yep.
debtor was not going to let that happen. So it's like, well, why are you even talking about it? You can't even do it. Did you read your debt agreements? The answer was no. Um, if the company does not even have a semblance of a forecast, meaning you talk to them, you ask for a forecast, and they say we don't have one, that's usually a bad
Or
sign.
if it's 10 times larger next year than this year.
Yeah, yeah. Like because I mean, in the end, a lot of forecasting is made up numbers. I find that they're also can be really unreliable, especially when it looks for because for investment purposes, people are trying to make themselves look as good as possible. It's like again, it's like dating, and someone says, "I'm going to be a future billionaire," and you're like, "Okay, I don't know if that's true because can you show me some progress towards that? Does it make actual sense?" It's similar with those forecasting. Is that what happened was there was a time where Vape Jet was almost acquired by a publicly traded company and we were doing our own due diligence on this publicly traded company. I asked them for a forecast and they gave me an excuse that was like, we can't give it because we're a publicly traded company. I was like, that's not true at all. Like, we have a signed agreement that I can't disclose any of this stuff. I can't trade based off any of this information. What are you talking about? And then we don't have one. It's like, okay, well,
Yeah.
that's really scary that you told me that first answer and now you don't actually have one. That's really, really strange. Um, but the other answer I would say that should be some part of your anyone's due diligence that's really basic and it's something that we had done too in the same company is call their salespeople and see what the process looks like.
Sure.
Just run through this. Pretend you're someone who's buying,
Yeah.
like you're a customer. Call them and see what that process looks like. If you can't get a salesperson on the phone, and that company is going to die.
Big red flag.
Yeah, it's one of the biggest red flags, and it's really the easiest ways to get to know a company is just look at what the sales process looks like.
Yeah.
And in the same example I had before, when we were doing our own due diligence, we could not get a salesperson on the phone. We spent 10 minutes trying. It just means that the people in the company are totally checked out because they have this, publicly traded company. They have this funding in the background. They're collecting a paycheck. They're not incentivized to do the things they're supposed to do. And I found that to be a huge issue. So I think those are
I,
the two things.
I wouldn't go as far as to say like a company is as strong as its weakest link because that would be unfair. There's definitely outliers, but if you're consistently going out there and you're seeing that type of result, you
Oh
can't get a
yeah,
hold of someone, et cetera. It really speaks to the culture of the business too, which is very important, right? Like you
yeah,
can't
absolutely.
if your sales guys aren't motivated, you are dead at the
Yeah.
end of the
But
day.
that's the thing is we tried to get we called multiple times. We called multiple avenues. There's multiple business departments that had sales. Nobody picked up. Like it
Yeah,
was impossible. Yeah.
that's I would be tremendously upset if I was the CEO of that company and I learned that. So,
Yeah.
um, okay, interesting. So let's kind of switch gears a little bit. We've gone through, the CFO toolkit, some diligence items, red flags that you look for. Um, Kind of move on to the fun stuff. Like, maybe take Vape Jet, for example. You talked about some sweat equity. How do you really think about incentives? Being financially tied to the ship obviously really matters versus being a mercenary. How do you think founders should structure comp and equity for finance leaders and key operators to keep the incentives clean?
So this is I would say that overall the philosophy is you look at Charlie Munger, Warren Buffett, and they have a statement which is you show me the incentives and I'll show you the behavior. I think that should underlie every conversation you have when you're looking at compensation overall for people, is that it really needs to be based off of aligning that incentive with the comp themselves. The difficulty is I never give one full answer. It's so difficult to tell with people because you have to understand the person you're across the table from you and like what motivates them. And again, that can be really difficult if you've only talked to them like once or twice, especially when it comes down to the interview process. So I find if you're really candid with them, they end up being more candid with you about the things they want, the things they need. And that really helps because different people have different reasons they're doing stuff. There's a company that I've talked to where one of their C-suite people, they already have all the FU money in the world. They don't care anymore. Like it's not necessary. Their work is not about that. It's that they want to support the CEO of the company and work really, like work on something where they're not the owner, but they're able to just essentially help them. Well, that person's incentives are going to be totally different. They're not interested as much about their financial rewards. They've already said as much, and it reflects in their comp structure and everything. So really
Mhm.
finding out what incentivizes that person. I find that there's a lot of roles where you start realizing that certain structures might not work for the person. An example is on the sales roles. I personally have found through all the companies I've worked with, equity tends to just be a little less instant gratification for some of the salespeople I know, where they're just not incentivized by that equity as much. They want bonus. They want that bonus. They want to like eat what they kill. They want to have a bigger bonus structure. So if you're talking to someone who is much more incentivized by that immediate gratification, well, the equity might not drive them. It's really that sales being tied directly to the amount of sales they have. So
Yes.
every person is unique. I would talk to the person, understand them, and try to structure the compensation to align that incentive as best you can. That leads to like certain roles are really difficult to hire for because of those difficulties in incentives. Sales is a really good one. Like higher level
Yeah.
sales are hard to hire for.
Yeah. It's funny that you say that. I'm actually going, confidentially, I won't say the company name, but I'm going through an exercise right now where I'm on the compensation committee of one of the companies that I sit on the boards of. And look, we typically take board representation in our investments. We're not the ones that are setting compensation for the employees, but we are actively thinking about management compensation and
Yeah.
incentives. And we find ourselves a lot of times, not even in this kind of specific example, but even in others, that management wants to take more cash out of the business than we think is appropriate, especially
Yeah.
after they've taken VC financing and you know equity financing from groups like us or others. How have you in the past, or any recommendations or advice, even to someone like me, to align ourselves, better with management who, in theory, should be very focused on creating equity value?
Well, that's the difficulty of trying to understand the person on the other side of the table. So my encouragement is pretend you're them for a second. Just be like, I'm not me now. I'm on their side of things. Why do I want that? Like the amount of compensation they want. And it could be a lot of different reasons. It could be that when they look at their own finances, their own personal finances, there's a certain set level of cash flow they need to be okay with their family. Like for example, it might be someone who has 5 kids, for example, right?
Sure.
So really truly understanding like why is that reason? Because sometimes it's not misaligned with the company. Like if someone has 5 kids and they're looking for more like, guaranteed cash compensation, I understand that.
Sure.
If it's someone who like for example like it's not that they're single person and they want the pay and they just want it because they want it. I kind of question it just a little bit. I was like, well, why is that the case? Why don't we
Buy your
draw this
Ferrari
out?
tomorrow when you exit.
Yes. Yeah. And then what I find is really helpful though is one of the biggest difficulties is people are bad at abstract thinking when it comes down to compensation. I always put it in an Excel sheet, true Excel sheet summarized, and say, this is the difference if we're incentivizing you tied in the company versus just your pure cash. Because arguably, the thing that happens with equity ties is the fact that upon exit or some sort of liquidity event or price round, anything like that in the future, the whole thing is that it should be exponentially larger than what they're making right now. If it's
Yeah.
not, then there's a misalignment incentive on my side. Because if right now I'm saying I don't want to, I want to pay you $100,000 less a year, but you're going to make 100,000 in like 2 years from now. Well, that's just the same number. Like, why would they going to be
Yeah.
incentivized,
No,
right?
that makes a lot of
So
sense.
yeah, so like really truly, I show them like this is the big difference between this number and this number. It actually has helped me in some cases where I was wrong, where I was actually undercompensating. Like I've done that in companies before where I thought without looking at the numbers that I was doing something well, but then once I put the numbers out, I was like, oh wait, if I were them, I wouldn't take this deal either. So that's one
Yeah.
of those moments where it really helps to have some not just empathy, but like just really understanding someone and what does it look like from their side when they're talking to me. And if you're able to almost be like a third person in that conversation, almost an arbitrator or something or mediator where you're like looking from both sides, it's pretty helpful because sometimes it gives you a really quick answer that they're totally misaligned and they're not going to work well, or maybe I'm being too hard and it's not going to work well. Because one thing you do want to do is make sure they're concentrated on the company. Everybody has side gigs these days. I mean, like I don't know a single person who doesn't have some sort of side hustle. You want them to be working as little as possible on their side hustles on other things. You want them incentivized and paid well enough to concentrate on what we're doing, but
Absolutely.
not, yeah, not in a way where they're misincentivized though.
Yeah, yeah. No, that makes a ton of sense. I might have a project for you, so we'll talk about that offline, Brian.
Yeah, for
Um,
sure.
so let's keep this one quick, and then I've got a couple more questions after this, and then we can wrap it up. But broad strokes, if somebody wants exposure to the cannabis industry now, how are you ranking the best lanes? Operators, brands, picks and shovels, distress receivership assets, or things that you think you should, avoid at all costs. And any insights there for investing in this environment where it looks highly likely that rescheduling and all that's going to happen. So things, structurally are about to change for the industry.
This is a tough one because I'm not going to give any specific examples of investable assets. But what I would say is that right now everyone keeps saying that we're in an everything bubble, and that's not true if you look at cannabis. Cannabis is the exact
Yeah.
opposite. Cannabis is totally
Hmm.
depressed. There's no money going into it. I keep telling people it's like the opposite of what George Soros talks about when he talks about reflexivity. It's actually still it's like a negative reflexivity where what's happened in the past is there was so much excitement and so much capital running into the cannabis markets, but every time capital ran in, it was totally mismanaged. I saw value destruction across the board with public companies, non-public companies. There's some shining stars out there like the Wylds who are just like fantastic, but that's a private company. And it's, I don't think they're taking money at least. But so like the
Hmm.
so when it comes down to the investable assets within cannabis itself, part of it just ends up being some fundamental analysis, which anyone can research. Like, how do I just look at like what are the potential future cash flows of the business? But I would say that if you are able to find a situation like the recent deal we did, this is one where it's like, well, it's in receivership. It's unburdened now with the debt that it used to have. It's something that actually has very high potential for an asymmetric bet. So really what I'm looking for is when I'm looking at the especially private deals is do I have any asymmetric bets where because it's high risk, I'm okay with, the money I put into it is gone. I'm okay with that side, but the potential upside is so great that I'm not going to put in the S&P 500 because my main recommendation for people is just throw your stuff in ETFs. I mean, it really is a
Yep.
guaranteed return. It's very few things have an expected value that comes out positive. It's like it's the opposite. Everyone calls the stock market a casino. It's the exact opposite. You go to a casino, if you do law of large numbers, you lose money over time.
You're going to lose every
Yeah,
time.
you lose every
Yeah.
time. In the end, you'll lose it. Stock market, it's positive EV. Like you just keep your money there. So most of the time I tell people just put your money in some sort of ETFs. But if you are going to look into cannabis, it's a similar principles to any other company. Don't get too cute with it, I guess. Like don't get too enamored with the idea of that it's cannabis because I understand the plant itself is magical, but the business are just fundamentals again. So look at like any fundamental business and then think does it have that asymmetric risk? Because the difficulty is most businesses and everything is a little bit inflated, like everyone talks about this bubble that we're in. So you'll go and look at companies and investments where it's insane values. You're like, man, this company's valued at 15 million, 20 million, 30 million. It's got like $1 million in revenue, not positive cash flow. It's like, well, why am I paying so much for it? You'll notice some deals in cannabis, especially now, because things have been so depressed, that there is some asymmetric, the risk in there, risk and reward. So the whole thing is
Yep.
that when you look at those things, write them down. If you want to get more quantitative with it, start putting expected values on it, put like probabilities of it actually succeeding. You can do it. It's easy with AI now. Just throw it into ChatGPT and say, "Hey, can you calculate these for me real quick?" and then double check the answer. Put the different like if you have like 10 different scenarios for like a potential investment based off of what you see, throw in your due diligence documents. What do you think I could actually make on this thing? And if it's high enough for you to risk your capital, then I would pull the trigger on it.
Yep. Yeah, you actually jumped right into my next question. You actually used a lot of words. I was going to ask, what made Brands feel like an asymmetric bet for you? So I think we answered that now. So I guess let's close it out with this. So, where does this industry go next, right? Like what's going to break this negative feedback loop that you're talking about, right? We had this huge influx of capital, a lot of mismanagement. I'm of the view, especially because we've been in this kind of depressed cap markets environment for about 3 years, that ironically, I think today it's actually easier to find really great operators that are standing out because there's nowhere left for them to shake their tin cup to raise capital to extend that balance sheet runway. So you're either A, surviving and thriving, or you're going under. So curious, kind of, what do you think ultimately breaks this negative feedback loop for the industry and gets these capital markets reignited? Obviously, we've got this now regulatory tailwind, which a lot of folks have been waiting for, and I do think it's a structural change, especially getting rid of 280E and the potential for incremental reform. Is it that simple? Do we just need regulatory tailwinds to come into play, or what actually where does this go next?
I got two things I'm going to say because first I'm going to comment on what you said about like the fact that it's easier to find operators. 100% agreed. Something that's really unique in startups themselves. It's usually the best startups are grown during like the worst times, and you'll see it consistently through like different companies that the largest and best companies do come out from the flames like a rising phoenix, someone could say. But it's also like the comment there too is that Oregon was kind of more of a free market in the past, and some of the biggest brands in the country came from Oregon, which is it's kind of weird when you think about it. You think they should be
Hmm.
from California or something, but it's Oregon. Wyld is Oregon company, and that's because that the battle tested operators were the ones that made it, and they fundamentally were better than the other companies. It wasn't just because like of funding or something like that. But speaking
Hmm.
of which, when it comes down to what I think is necessary it's essentially there needs to be a spark. And what I mean by that is that there needs to be a company that is able to take capital and just take that capital and grow a company exponentially. That is the thing that will make more capital flow in the markets. There needs to be a shining example that goes through the whole cycle. Because so far, what's happened is that I think off the top of my head, pretty much all the publicly traded companies, save maybe one or two, really have destroyed all the value of their companies. And there's some that are doing like just kind of floating by. I think they're waiting for
Sure.
that catalyst of just legalization. But overall, like most of them just destroyed the capital. So if there is a company that's able to take that capital, grow it, and then investors get excited, that'll start that feedback loop of more people open to it. Obviously, banking laws, financing, as long as it's easier to get money, more money will flow into an industry. But to really truly make it like go up, it's going to be like a company that really is able to take that capital and build a fantastic business that will
Yeah.
really change things. And it almost makes me think of something like an Nvidia, but not exactly the same because that's a whole different style of business. But that Nvidia was able to like just basically turn the markets around. There needs to be like something in the especially publicly traded cannabis space because
Yep.
that's one where it's easy to see the what is happening in the
Hmm.
business that is able to just grow their business like that. So I'm curious to see what that'll look like. I'm not exactly sure.
Yeah. No, I think you're absolutely right. That's kind of been our train of thought at Key as well, is like, look, we need these regulatory catalysts. There's just too much red tape for these companies to have to work through that needs to come down, and these barriers to operate like any other business. But I think without the public markets starting to come back in a meaningful way, you're going to have this sentiment that the cannabis industry continues to be in this kind of depressed environment. There's absolutely truth to that. But I also think from our perspective in the private markets, it's really an opportunity to find kind of diamonds in the rough
Oh yeah.
during this transition period. So, super fun conversation, Brian. I thought it would be a great podcast. So I'm glad that we were able to do this today. Any kind
Yeah,
of
I think
final thoughts you'd like to share before we wrap it up here?
more philosophically is that you just never know what's going to happen in the world. Like, you just, I think that it's something that Charlie Munger talked about too, is that if you ever see something that you think might be a good opportunity, you should just jump into it. I mean, I'm not a person I think typically would have been into the cannabis industry, but I just got lucky at the right place, right time, and I was open-minded enough to jump into it. Similarly, in cannabis investing, I think people are a little too scared of it now because it's that exact opposite. I think if anyone looks at these opportunities and is able to find something they think might work, I think it warrants investigation, further investigation. And there are those diamonds in the rough right now. There is opportunity to pick up like there's blood on the streets, so to speak.
Yeah.
There are great assets out there that people aren't scene, and I think that there's opportunities here to jump in. And anyone who's interested in cannabis, I think it's a good time to get in, even though people would say it's a bad time.
Yeah. Well, after meeting you and kind of getting to know you a bit and realizing how deep you are able to get into the weeds, no pun intended, it's an absolute pleasure that we've now been able to partner on a deal. I'm very appreciative of your confidence and in Key and the partnership here. So thank you so much for taking the time for the podcast today. Super insightful. I think for folks that are either just getting their feet wet in the cannabis industry or have been, on the edge of the diving board, you really provided some great thought and insight into how they should maybe be thinking about investing in deals as well. So thanks so much for your time, Brian, and I look forward to the continued partnership here.
Yeah, I'll say one last thing, which is if anyone who's interested in anything, feel free to contact me on LinkedIn. You'll see my name on this podcast. I found one thing in cannabis that really helped me is that I'm just open to helping anybody, and I don't expect anything back. So if you ever have a question or there's some reason like you need to reach out about something, feel free to ping me, and I'm happy to answer any questions.
Well, you heard it here. You heard it here first, folks. So if you do want to get in contact with Brian, find him on LinkedIn. You can reach out to us. I'd be happy to put you in touch with Brian directly as well. Thanks so much, Brian. Appreciate your
Yeah,
time today.
thank you so much.